Hi, Else here. In this video, we'll be exploring the classification of business activities and why this information is important. There are three main business activities: financing, investing, and operating. In order to better understand these activities, let's start a business and walk through them. Let's say you want to start a business that develops iPhone apps. You've seen other people do it, and you figure it's an excellent way to join the 250,000 people who start businesses every year in Canada. If you start this business, what do you think you'll have to do first? The first thing is to get financing for your business. Financing activities are all about getting or repaying cash. You may have savings of your own, but you might need to borrow money. That's called debt financing. If you're a corporation, you can sell shares. That's called equity financing. Financing activities are all about funding your business. Remember that it involves not just getting the funds, but also paying them back or paying dividends. After you raise the funds, you'll need to spend it. Investing activities is when you buy the things you need in order to run your business, generally property, plant, and equipment. For instance, for your app development company, you'll have to buy computers. Any long-lived assets that you use to operate a business are considered investing activities. Investing activities generally involve the use of cash because you tend to spend to get what you need for your business to operate. Once you've financed your business and bought what you need to run it, you're going to have to begin operating the business. That would include selling your apps to earn revenue, service revenue in this case, and all the costs you'll incur to earn that revenue, things like paying the salaries of your employees, the rent for your space, and anything else. If you're using, consuming, or incurring costs to help you generate revenue, those are considered operating expenses, and they're part of the operating activities of a business. Let's double check your understanding of the types of business activities. Remember to pause the video and answer first. In your app development company, if you sold your old equipment, it would be considered an If you said A, operating activities, because you sold something, you're incorrect. You don't sell old equipment day to day as part of your operations, so it's not operating activities. If you said C, financing, because it brought in cash, you're wrong also. Financing involves only debt or equity financing. The correct answer is B, investing activities. Note that in each activity, what goes into that activity comes out of that same activity. The purchase of equipment is recorded under investing, and therefore the sale of equipment is also investing. Similarly, if a company borrows money, it would be under financing activities. When they pay the money back, that would also go under financing activities. Let's practice a bit more and look at a few other transactions. For the next slides, classify each transaction as operating, investing, or financing. You should also be able to say if it's an inflow or an outflow. Remember, to do this, you have to know the definition of each of the activities. Dividends of $100,000 are paid to shareholders. Dividends involve shareholders, and the sale or repurchase of shares is a financing activity, and therefore, so are the dividends payment. Financing activity, outflow. Payment of $250,000 are collected from customers. Anything having to do with customers is part of the day-to-day operations of the business, so the correct answer is operating activities, inflow. Pay $20,000 to renovate a store. This is an investment in future revenue generation and therefore is part of investing activities, outflow. Why is knowing about the different activities important? Accounting is an information system that provides financial information for decision makers. That information is useful only if those using it can understand it. Remember that the main users of financial information are investors, lenders, and creditors. Many of those users believe that the statement of cash flow is useful for predicting how much cash will be available in the future for either repaying debts or paying dividends. The statement of cash flow is divided into three activities: financing, investing, and operating. By understanding the different types of activities, you can tie that understanding into the structure of the cash flow statement, which we'll be covering in the next series of videos.